The U.S. banking sector is standing at one of the most important turning points in modern financial history. After years of easy money, rapid growth, and technological change, the system now faces a new reality shaped by high interest rates, tighter regulations, and shifting consumer behavior. This is not just another market cycle, it is a structural transition that will decide which banks thrive, which struggle, and which disappear. For investors and everyday Americans alike, understanding this moment is critical because the health of the banking system influences everything from stock markets and home loans to small business growth and retirement savings. To truly understand why this crossroads matters, we must look at the journey that brought us here. For more than a decade after the 2008 financial crisis, interest rates remained historically low. Banks grew accustomed to cheap funding, strong loan demand, and rising asset prices. Risk appeared manageable, and liquidity seemed endless. But when inflation surged in the early 2000s, the Federal Reserve was forced to act aggressively. Rapid rate hikes changed the financial landscape almost overnight. Assets that were once considered safe, such as long-term government bonds, suddenly lost value. Funding costs increased, and weaknesses that had been hidden during the era of easy money began to surface. One of the most serious risks facing U.S. banks today is interest rate volatility. While higher rates can increase profits through better lending margins, they also create pressure on balance sheets. Banks that invested heavily in low-yield long-term securities now face unrealized losses. At the same time, borrowers are becoming more cautious. Mortgage activity has slowed, corporate borrowing is more selective, and consumers are increasingly sensitive to credit costs. If economic growth weakens or unemployment rises, loan defaults could climb, directly impacting bank earnings and capital strength. Another critical issue is confidence. Banking is built on trust more than any other industry. Depositors must believe their money is safe, accessible, and protected. In the digital era, confidence can evaporate in hours rather than weeks. Mobile banking allows massive withdrawals with a few taps, and social media can spread fear instantly. This means liquidity management, transparency, and communication are now as important as profitability. A single rumor or misunderstood headline can trigger market reactions that once took months to develop. Regulation is also reshaping the industry. After recent stress events, U.S. regulators are strengthening oversight, increasing capital requirements, and conducting more rigorous stress tests, particularly for mid-sized and regional banks. While these measures aim to protect the financial system, they also raise operating costs and limit risk-taking. Smaller institutions may find it difficult to compete, leading to consolidation and a banking landscape dominated by fewer but stronger players. Yet this crossroads is not defined by risk alone. It is equally a landscape of opportunity. Higher interest rates, when managed correctly, can significantly improve profitability. Banks with strong deposit franchises and disciplined asset management can benefit from wider net interest margins. This creates the potential for sustained earnings growth, especially for institutions that avoided excessive risk during the low-rate era. Technology is another powerful driver of opportunity. Digital banking, artificial intelligence, and data analytics are transforming how financial institutions operate. Automation reduces costs, improves fraud detection, and enhances customer experience. Banks that successfully integrate innovation into their business models can operate more efficiently, serve customers better, and compete with fintech firms that are reshaping consumer expectations. From an investment perspective, periods of uncertainty often create mispricing. Banking stocks, historically, tend to trade at discounts during times of fear, even when long-term fundamentals remain strong. For patient investors, this environment can offer attractive entry points into high-quality institutions with solid capital, diversified revenue streams, and proven risk management. The key is not to chase short-term headlines, but to focus on long-term resilience. Looking ahead, the U.S. banking sector is likely to experience a period of transformation rather than collapse. Business models will evolve, weaker players will merge or exit, and stronger institutions will adapt to new regulatory and economic realities. The winners will be those that balance profitability with prudence, innovation with stability, and growth with trust. In the end, every major financial shift creates both fear and opportunity. The current crossroads is no different. It represents the end of one era and the beginning of another. For investors, policymakers, and everyday Americans, Toteni, the decisions made in this phase will shape the financial system for the next decade. Those who understand the risks, recognize the opportunities, and position early may not only protect their capital, but also benefit from the next chapter in the evolution of the U.S. banking sector.